2021 has been an exceptionally good year for the markets, both within and outside of South Africa. In fact, 2021 has been the best year for South African stocks in more than a decade. Although you might be surprised to find out that the gains had little to do with local factors. And seeing that we are now well into the new year, many people are curious to know where they should actually park their money next to get the best performance. So in today's video, I will briefly reflect on which stocks and ETFs performed the best in the South African market in 2021, why these performed the way that they did, and then I will give you my predictions of which sectors I will be watching and investing in for the year 2022. So, without further ado, let's unravel the JSE. So instead of reading the best and worst performing stocks and ETFs on the JSE for 2021 like a parrot, and in order to save a bit of time, I will just gooi the stats here on the screen and leave a link down in the description where you can download the Excel document. I will highlight some of these ETFs and stocks as I go through the video, so maybe either pause this video to scan through the list or just download the document and keep it open so that you can follow along. Okay, so right off the bat, it is clear that the ETFs that tracked the S&P 500 completely dominated the markets last year. The OneVest S&P 500 Infotech ETF did the best with an annual performance of 45.5%. This is insane for an ETF. So why did the S&P 500 perform so well? In my previous video, I delved a lot deeper into the US market that I would encourage you guys to check out. But in essence, the performance of the top 500 companies, which is what the S&P 500 index tracks, was mostly driven the past 3 years by behemoth technology growth stocks like Apple, Tesla, Microsoft, Nvidia, and Google. These companies performed really well, mostly thanks to the very low interest rates that the US have been experiencing the past 3 years. Firstly, low interest rates means that these companies could borrow money at cheaper rates, and thus they have more capital available to fund their growth. Also, because of the low interest rates, safe investment options like the bond market took a massive hit because, if you can remember, bonds are basically just like debt instruments where the government or companies borrow money from the investors. So if the interest rates are low, the return on bond investments are also really low. This makes these investments much less attractive, as the low returns may cause your investments to perform so poorly that it cannot keep up with inflation, thus in essence causing your money to lose a lot of its purchasing power. This caused many investors in the US market to pivot away from bond markets towards higher risk, higher return assets like property and stocks in order to try and get better returns to keep up with the rising inflation rate. This caused more demand in the stock market, and as we all know, higher demand usually translates to higher prices, hence why the price of most shares in the stock market went up. Now, a second reason why low interest rates caused the value of growth stocks to go up is because when these stocks are valued, meaning when the smart people determines what their share value will be, their value is mostly anchored to the expected future returns, meaning how much money they are expected to make in the future. So again, if interest rates are low, they can borrow more money at cheaper rates, which means they can fund their growth at cheaper rates, thereby increasing their profit margins, thereby increasing their future expected returns, and therefore increasing their share prices as well. Make sense? Okay, next we'll see that global property sectors also performed quite well. This is also mostly thanks to the low interest rate environment in the US. Low interest rates means that mortgages are much cheaper, thereby making it a much more attractive investment opportunity than boring old bonds and cash, hence why many investors expanded their real estate portfolios. Also, because there were fewer strict lockdowns last year, the economy started to open up a lot more, which helped to fill up empty office buildings as well as increasing the traffic to retail outlets, thus increasing the demand for property both in the business and commercial sectors. And moving further down the list, we can actually see some local ETFs also competing well with their offshore counterparts. One ETF that really surprised me was the ABSA New Funds Value Equity ETF that placed fourth on our list with a staggering performance of 39.8%. This ETF mainly focused on the value stocks in South Africa, which performed really well this year. And then at the bottom of our top 15 list, we can also see the MSCI World ETF also featuring. These ETFs are much more diversified than the S&P 500 or Nasdaq 100 ETFs, as they include all the companies from the developed markets around the world and not only just the US. But seeing that the US focused ETFs performed the best for the year, it is clear that the US companies kicked dust into the eyes of the rest of the world. And then looking at the worst performing ETFs for the year, at the very top we can see the Satrix MSCI China Feeder ETF with a dismal performance of minus 16%. This was mostly due to strict regulatory practices, especially on Chinese tech companies, and renewed fears of the Corona that wreaked havoc on the Chinese stock market. We can also see that the commodity ETFs that tracked palladium, rhodium, platinum and gold also performed rather poorly, and I believe that this was mostly caused by the increasing attractiveness of alternative investments like Bitcoin and other cryptocurrencies, which caused investors to look the other way from these shiny precious metals. And then lastly, we can also see that the global bond ETFs did not do so well either, mostly because of the low interest rates mentioned earlier that caused these type of investments to look much less attractive to investors seeking investments that can beat inflation or at the very least keep up with inflation. On the individual stock side of the market, ArcelorMittal SA Limited came out on top with a really impressive return of 745% for the year. Steinhoff made a solid recovery from its dismal position a couple of years ago, being placed third with a performance of 369%. Purple Group, which we all know and love, placed 9th with 215%, and Richmond placed 10th with a performance of 206%, mostly thanks to the fact that people were spending a lot more money on luxury items like jewelry and much less on travel due to restrictions placed for the majority of the year. Overall, the top 15 JSE stocks produced an average return of 267% for the year, and the top 15 JSE ETFs produced an average return of 38%, which is very impressive for the South African market. Now, I do have to mention that the JSE has largely benefited of global developments in the past year, and that its performance is not an accurate reflection of local developments. Roughly 75% of the JSE is exposed to offshore markets in one way or another. South Africa, together with many other emerging markets, benefited quite a lot from the extraordinary measures taken by the central banks around the world since the start of the pandemic in an attempt to support financial markets. This resulted in trillions of dollars being pumped into the economies, and seeing that most of the companies have since recovered, the positive sentiment in the US market drove markets up, and this confidence tends to rub off on emerging markets like South Africa. The global boom in commodity prices has also improved the profits of mining companies in South Africa, and seeing that the rand remained fairly firm against the US dollar for the majority of the year, this kind of gave investors a lot more confidence in the South African economy, hence boosting its overall stock market value. Okay, so where do we as South African investors focus our attention for 2022? Well, firstly, as you have seen from statistics from 2021, it was global and not local factors that influenced the surging stock market, and that the offshore market still dominated the South African market, even though the South African market still performed really well. The JSE All Share Index, which tracks all the companies in South Africa, returned an average of 14.5% for the year, whereas the Wilshire 5000 Index, which tracks all the companies in the US, returned an average of 24.7% for the year, which is 70% more than that of the JSE. So, just from these numbers, it is clear that we need to diversify our investment portfolios to gain enough exposure to the offshore markets so that we can benefit from these insane growths. Now I know what you want to ask. Peter, is there a guarantee that the US market will continue to excel like this for the year 2022? The answer is no one knows for sure, but probably not. So let's see what we do know and how 2022 might play out. We know that the inflation rate in the US is currently insanely high, hovering around 7%, which has been the highest it has been since 1982. This is mostly due to the exact same reason why the Fed tried to save the economy by pumping millions and millions of dollars into the markets. Now, we as South Africans will just laugh at 7%. As we are quite used to levels of around 6% per year. But this is not the case for the US, where they aim to keep inflation at around 2% per year. Now, in itself, high inflation is already very bad for stocks because it erodes wealth, it increases borrowing costs, it increases the input costs as materials and labor becomes much more expensive, and because it reduces the overall standard of living. So, because high inflation is already such a bad thing, several of the big boy banks around the world will start withdrawing their support measures for their economies. We can already see this happening in the US. In order to try and bring this inflation number down, the Fed is planning on increasing the interest rates 3 times during the year of 2022. Why? Because higher interest rates will make it more expensive to borrow money, so people will be less likely to buy stuff, thereby decreasing the demand for these stuffs, thus decreasing the price of common goods and services, and therefore hopefully bringing down the overall inflation rate. Ja, maar Pieter, what does this mean for the stock market? Well, high interest rates are generally also bad for growth assets such as stocks and property. Firstly, high interest rates makes it much more expensive to borrow, so companies focusing on growth, aka growth stocks, whose valuations are mostly based on future earnings, will get absolutely smashed as they will be much less likely to maintain high projected profit margins if the cost of borrowing money goes up. We have already seen many growth stocks getting pounded by the end of 2021, much for this very reason. Secondly, higher interest rates makes income producing assets like bonds and even cash much more attractive investments, and this might convince many investors to pivot away from high risk assets like stocks and property towards more stable assets like bonds. And to sprinkle even more doom to this melting ice cream cake, most US growth stocks are disgustingly overvalued because of all the hype of 2021. So these stocks are prone to losing even more of their value moving into 2022. Contrary to popular belief, we are actually still in a pandemic, and who's to say that there won't be another deadlier and more contagious variant that comes knocking at our door, driving fears into everyone's mind, resulting in more severe lockdowns and in turn lots of economic disruptions. This will kill the office and retail property markets worldwide and probably cause many investors to pull funds out of these assets out of fear. Okay, so taking all this potential negativity into account, it seems like most experts agree that the safest and most reasonable assets to park one's cash for 2022 will be in the bond market, specifically of those in emerging markets such as China, Indonesia, South Korea, Russia, and yes, you guessed it, good old South Africa. The reason for the emerging markets is because of the fact that the developed markets are currently crazy overvalued. In fact, emerging market stocks have been the cheapest it has been in 15 years when compared to the US peers. So it seems like a lot of value could potentially be snatched from emerging markets, giving the cheap discounts when compared to the US counterparts. If, and this is a big if, the world moves past the pandemic for the most part, then people will most likely start to shift their spending from goods and luxury items to services like travel and transport. So companies in these sectors who have suffered tremendously the past 2 years may actually start to regain their losses, posing a lot of potential for investors. The world is also moving towards much more sustainable environmental practices, as there's a growing demand from investors to invest in funds, companies and causes that will act in the best interest of the environment and humankind. So the ESG sector will also be really interesting to watch as more and more investors become more intentional as into which companies they want to invest in order to make the world a better place. On the South African side of things, the returns of 2022 on the local market will largely be influenced by the direction of interest rates, inflation, SA's power issues, what will happen in China, and of course, what will happen at the next ANC elective conference. Most investors expect Ramaphosa to win another term as ANC president, but if he doesn't, then this could be quite disruptive for our economy. So, to wrap this all up, for someone who likes to pick individual stocks, it seems like the best place to look this year is in the small cap sector, potentially in the emerging markets, focusing on value stocks and ESG investing. For someone who prefers to just invest in ETFs, but who also like to see where they can get the best returns, it might be worth focusing on emerging market bond ETFs, as well as ETFs that focus on value stocks within the ESG environment in the small cap sector. But for most of us mere mortals, everything that I just said in this video is completely irrelevant. What? You just wasted 15 minutes of my life? No, these are all really important things to know, as they will make you a better informed member of society. The truth is, these are all just speculations of what might happen. But as we all know by now, anything could happen, and we might just get thrown with another curveball like what happened in early 2020. So the best thing to do for the majority of us for 2022 is to stick to our investment strategy, to cancel out all the noise in the markets, and to continue to invest in the market consistently every single month. If you have a good investment strategy in place that are well diversified across all the asset classes, both locally and offshore, then you don't have to worry about what the markets might or might not do. If you don't yet have such a strategy in place, or if you want to revise your own, then please go and check out this video where I explain exactly how you can do this. And if you would like to learn more on how exactly you as a South African citizen can invest in the offshore markets, then go check out this video as well. With that said, thanks for watching this video. I hope you found it helpful, and if you did, then please clap that like button for the YouTube algorithm. I'll see you guys in another video next week. Cheers.